What's happening, Hardscapers? This is episode 349 of the How to Hardscape podcast, where we talk about how you can start and grow your hardscaping business. And on today's episode, we're going to be talking about dLER and mLER, as well as budgeting, overhead recovery, all of this today. And if you don't know, the dLER is direct labor efficiency ratio. mLER is management labor efficiency ratio. And these were brought up by Greg Crabtree in his book, Simple Numbers and Simple Numbers 2.0. If you haven't read these, I highly recommend that you do. We've had Greg on the show 3 times in the past, and he is a great guest, and those books are amazing. You can go to howtohardscape.com/books, and you can see all of our book recommendations, and those 2 books are very high on that list. But this is budgeting season if you haven't already done it. And we also want to take this opportunity to talk about the How to Hardscape headquarters software and what that can help you with in your business in terms of budgeting, estimating from your budget to recover your overhead and remain profitable, and all the different features that we have in there beyond just being a budgeting and estimating tool. With this, we also have a spreadsheet that we've created, and these are features that are being rolled out within the software. But because I created the spreadsheet already, I am doing workshops if you are interested. The first one's going to be Monday, February 9th. You do get your own copy of this spreadsheet. It allows you to create a budget and know what these 2 different ratios are for dLER, mLER, what they tell you, as well as all of your labor costs and what your rate should be based on what you set in your budget for labor and for each employee, as well as equipment rates and what they should be for each piece of equipment. And just pretty valuable insight that you can get just from this spreadsheet alone. We'll be doing 1-hour workshops. So like I said, first one's Monday, February 9th at 7:30 p.m. Eastern time. You can sign up for that. The link is in the show notes, or you can just message me at How to Hardscape on Instagram, or you can go to howtohardscape.com. There's an events in the main menu. Click on that. You'll see that workshop right there. And if you're listening to this in the future, I'm going to try to do at least one more of these events during this winter period of time. And I will plan on doing one quarterly throughout the season as well. However, you can just buy the spreadsheet. It's on our website, and you will get a how-to video of how to actually use it. Just with our workshops, you get a little bit more hand-holding and are able to ask questions throughout that in what this can do for your business. And if you are a How to Hardscape headquarters member, you get free access to this. So you can send me a message, say that you want to join in on the workshop, or get the spreadsheet yourself and do it for yourself. But also, as a headquarters software member, you get as many one-on-one calls with me as you want. You always have my Calendly link to be able to book those calls at any point in time. So feel free to take advantage of that. And if you are interested in the headquarters software, send me a message at howtohardscape, or send me an email, contact@howtohardscape.com. I didn't mention overhead recovery. It also shows you what your markups are on your cost of goods sold. So materials, equipment, labor, and subcontractors for a multiple overhead recovery method. So different percentage markups on each of those. A single overhead recovery method, so a single percentage markup on all of those, and as well as a labor rate recovery method, which is my preferred method, but we can also talk more about that throughout this episode. And before we get into it, I want to say thank you to our sponsors. Cycle CPA. If you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And Knowledge Tree Consulting. George and Peter there are efficiency consultants in our industry, and I've had the privilege of having them both on one episode of the How to Hardscape podcast, and George multiple other times. And without further ado, let's get into today's episode. So what I'm going to do here is I'm going to run through what this spreadsheet helps you do, but also what you can do on your own for creating a budget if you don't want to use a spreadsheet, but want some sort of insight into your business. Spreadsheet just makes it so much easier. I've put a lot of hours into actually creating the spreadsheet with all the different formulas involved. I can talk a little bit about the formulas on this episode, and maybe you can revisit this when you're in the office and are able to write down some of these formulas. But for the most part, part, a spreadsheet is just going to make it so much easier, so much more simplified. Now, the reason why we budget is so that we can create these data points that we know what we need to charge for our labor, equipment, our markup on materials, as well as our markup on subcontractors, to be able to recover our costs, our overhead expenses. So instead of just throwing a number out there for a unit rate, say pavers are $30 a square foot or whatever you're at, we can actually very accurately get down to what it needs to be for your business to charge out what you need for recovering your overhead and remain profitable. So by setting a budget, you're able to define exactly what you need to charge for each of your employees in the field and the average rate for employees in the field, as well as each of your pieces of equipment and what their rates are for hours versus days and so on, what your percentage on markups of materials are as well, and even subcontractors. And basically what the spreadsheet allows you to do, and what our software allows you to do, the headquarters software, is it helps you to create a set amount of time that you have in your season to be able to create the total amount of hours that you have in your season or year to be able to recover your overhead. So you get however many weeks that you have in a year, however many days per week that you work, and however many working hours per day to give you your total working hours. Now you can also account for unbillable hours to subtract from that in your business, which is important. And then at the very end, we ask for a sales goal for this specific budget, and we will revisit that. It's just setting the first amount that you're thinking of for your sales goal for the year. And then we've got 3 different tabs at the bottom beyond just this information. So we have the cost of goods sold, we have the overhead tab, and we have the profit tab. Cost of goods sold is going to ask you for your field labor, your equipment, your materials, and your subcontractors. So if you're looking at your numbers from last year and you decide you want to grow your business by X percentage, say 50%, or let's just make it easy and say 100%. Well, to be able to do that, you're either going to have to find ways to be more efficient with the field labor that you already have, or you're going to need to be able to hire more field labor, increase crews to be able to get to that 100%. So you're going to double the sales that you did last year. But what we ask you to do to start off with is to input the current number of employees that you have, the current equipment that you have into the spreadsheet. So you would list your employees, put in their hourly wages, and then based on the amount of hours that you have in your year, it's going to give you a total wage for each employee. Then we're going to add a labor burden percentage markup. This is going to take care of the unknowns that you might not know. Maybe your bookkeeper accountant can help you figure these out, and you don't have to do a labor burden percentage markup on your labor, and you can just do that at the hourly level. But this takes care of things like payroll taxes, insurance costs, benefits, vacation pay, things like this that you'd want to account for. And what that's going to do is going to give you a total payroll for your field labor, the number of employees that you have, and the percentage of revenue that your field labor is going to take up. With equipment, we're going to add a few different things. We are going to input the cost of replacement, the years of use, and the resale value on each piece of equipment. You can lump equipment together. For example, you have 3 3/4 ton trucks. You can lump them all together, put a cost of replacement for all 3, add those up. The years of use that you're going to get out of those trucks. Now, the cost of replacement is what you would pay today to replace that equipment, not what that current equipment is worth. The years of use is going to be the amount of time you expect to use that truck or piece of equipment for. For example, if you plan on buying a brand new truck, and you know that you put on 20,000 miles on that truck every year, well, after 10 years of use, it's going to be at 200,000 miles. And what would be the resale value, which is our next field that we would enter to be able to recapture after a truck, you're selling a truck with 200,000 miles on it? What is the resale value of that? The formula here is cost of replacement minus the resale value, whatever that figure is, divided by the years of use to give you your cost per year for that piece of equipment. If you plan on buying used, not new, totally fine. Put in the used cost of replacement for that vehicle, and then however many miles that vehicle has on it when you plan to purchase or whatever your goal is to purchase. Say it has 100,000 miles on it. What is that cost of replacement? So what would it cost you for a truck with 100,000 miles on it? And if you plan to use it for 5 years, you put on 20,000 miles a year. Once again, we're back at that 200,000 mile mark. And what would be its resale value at a truck with 200,000 miles on it? And then another thing we want to add to that cost per year for that vehicle is the expenses per year that you put on it. So maintenance, repairs, fuel, licensing, insurance. Add that to the cost of year for that vehicle to give you a total cost of year for that vehicle. Now, these are equipment that are used in the field. So this is not overhead equipment. We will get to that. These are things that produce revenue in your business. So with this, if you do have anything in cost of goods sold, it needs to be applied to the project at the project level to be able to recover the cost of that. And with that said, you can also add a utilization rate. So what that means is if you use your truck every single time on every single job, your utilization rate can be 100%. If you use your, say, skid steer on 60% of the jobs or 60% of the days that you're working, you can put a utilization rate of 60%. And what that's going to do is actually going to increase your cost per hour for that piece of equipment. Now, our cost per hour is not factoring in our overhead recovery for equipment, as well as the profit, the net profit that we want to make on that. It's just going to give you your costs, what it costs you, the business, to have that piece of equipment. And when you have every piece of equipment listed, for me, I consider anything over $500 a piece of equipment. So I put anything that I own that is actually producing revenue in this list for myself, and I then get a percentage of revenue that my equipment is in the field. The next thing we want to do, actually the next two things we can cover both together, is materials and subcontractors. So separate, but they both work on the same way as in terms of putting in your forecasted amount for materials. So if you did $500,000 last year in sales, in revenue for your business, and you then have you want to grow by 100%. So you want to go from 500,000 to $1 million. First off, what would you have to do to be able to add labor to hit that number? As well as if you did, of that 500,000, 100,000 of that was materials, then you're likely going to have to do 200,000 in materials to be able to hit that $1 million mark. Now that might differ if you're adding different services to hit that total revenue that you're getting. So maybe you're getting into swimming pools or other types of features that are actually going to come with a higher material amount. You may not want to go off of a simple, we did 100,000 last year in materials. We're doubling our revenue from 500,000 to $1 million. We're going to be at about 200,000 for materials. So just a little bit of thought process there. And once again, it's going to give you a material percentage of revenue. And then finally, same thing with subcontractors. What are you planning to do in terms of subcontractors? What did you do last year? What do you plan on doing this year based on your sales goal? But also, are you adding features that you or services that you're providing for your design builds that are going to come with more subcontractors? So once again, that swimming pool example, maybe more subcontractor work, or you're getting into gas fire features. So you have a gas subcontractor that's going to be added to your subcontractors. You'll want to forecast that. And with that, we have our cost of goods sold completed for budgeting. And then we're going to go to overhead. Overhead is 3 different layers to it. We've got labor, equipment, and general expenses. Labor for overhead is anybody that is not labor producing or producing revenue in your business. So as the owner operator, if you or owner of the business, if you are an owner operator, so you're in the field and of course you're doing things like sales, design work, sending off emails, so admin tasks, you do want to be in both cost of goods sold. So what is a fair market value for the work that you do in the field? Put that in COGS, so cost of goods sold, labor. And then you also want to put yourself as an overhead salary. So add up the amount of time that you spend doing these different tasks, say design work, say sending off emails, sending off estimates, creating estimates, so on and so forth. What would it cost you to, for these are likely part-time tasks, you're not doing them full-time, you're likely full-time in the field, but what would it cost you to hire somebody part-time for each of these tasks and create a fair market wage and put that in as a salary in your overhead labor, and then continue that with anybody else that you're actually paying. So not a fair market salary, but what are you actually paying your admin staff or anybody else that you have outside of the field? And then you want to add, once again, another labor burden percentage, and that would give you your total amount for overhead labor as a percentage of revenue. For labor burden, for things like insurance, it's going to be less for office workers than it will be for in-field workers. So consider that in your labor burden percentage. But once again, talk to your accountant, talk to Cycle CPA, see if they can help you with your specific labor burden percentage. Next thing, equipment. Exact same thing with doing it with cost of goods sold. Now, with this is things that you don't use for producing labor. So if you are using a truck to go on sales calls, that's different from your truck that you use for doing the actual work in the field. You can put that in here. I have, for me, my computer I put in here because I want to recover an amount for my computer, and it's over $500. So any equipment that is overhead, it's not producing revenue in the field, I would put in here. Once again, cost of replacement, years of use, its resale value, and the amount of expenses that you have per year for that. Now, alternatively, if your cost of goods sold equipment is used on every single project, you could put that in here under overhead equipment. It's just going to recover it as if it's an overhead expense on every single job, and you don't have to worry about applying equipment to projects individually. You know that by having it in overhead equipment, it's going to be recovered using our overhead recovery methods, which we'll get to, on every single estimate that you're sending out. However, that will skew your gross profit margin. So after your revenue minus cost of goods sold, your gross profit margin will be higher using this method or going that route than if your equipment was an actual cost of goods sold, which would mean your cost of goods sold would be higher and then your gross profit margin would be lower. And this is why don't listen to other people's numbers, because you don't know how they're organizing their business, and their numbers could be skewed not based on what you are actually doing in your business. This is why budgeting and knowing your numbers is more important than thinking about what other people are doing and trying to compare your numbers to somebody else, because you don't know how they have their business set up. Last thing, general expenses. Anything and everything that comes out of your business, whatever you use to write off in terms of taxes, come tax time, you want to insert here. So I have a list of anything and everything that you would want to account for this. I can go through it really quick, but it is a list of about 40 different things. And in our spreadsheet, we have it already populated there for you. It's going to give you a percentage of revenue, once again, for your general expenses. But this is accounting, advertising, bad debts, bank charges, cleaning, computers, contributions, credit and collection costs, conferences, dues and subscriptions, education and training, employee benefits program, gifts, liability insurance, building insurance, interest expense, business license and permits, legal fees, meetings, office supplies, officers' compensation, payroll expenses, rent, software, taxes, phone and internet, tools, travel and entertainment, uniforms, utilities. That's a good breakdown of going about this for your business. And with that, you've created your budget. On our profit tab, you will see your net profit based on your budget. You'll see your net profit margin as expressed as a percentage of revenue. And with this, we can now change our forecasted sales to see where we would need to be to get to a certain net profit percentage that we want. So if I put in, say 500,000, I would see maybe that my net profit is too low to where I would want to be. I would say base minimum 10%. Think of your net profit as a return on investment and return on risk that you take on as a business owner, which is incredibly important, because if you were to invest it into the S&P 500 or averaged out over the years, maybe you'll make like an 8% return on investment on whatever you put in there over a long period of time, but 8% annually. And if you're not making 8% in your business, you might as well just be investing into that as opposed to trying to reinvest into your business and hope that you're going to get above 8% as a net profit margin. So just the thought process on that. Net profit is your return on investment into the business, as well as a return on risk that you take as a business owner, which is very important to consider. with this, you can play with your revenue forecast to get to a net profit margin that you want to get to. Just know, going back to our 100% increase in sales example, if we're going from 500,000 to $1 million, how are you going to get there? What is it that you are going to become more efficient, cut in terms of costs, or even actually add another crew or employees? And how are you going to go about that to know that you are going to keep the standards in your business? You can also see your gross profit, and that once again is your revenue minus cost of goods sold, as well as your cost of goods sold expressed as a percentage of revenue, and your overhead expressed as a percentage of revenue. And this is where we get into the direct labor efficiency ratio, or dLER, and management labor efficiency ratio, or mLER. And what these numbers tell you, based on Greg Crabtree and the number of businesses that he has done work for, is that he's seen if you have a direct labor efficiency ratio of 2.0 or higher, you are efficient with your labor. And what that is it tells you for every $1 of labor spend, you are making $2 in gross margin. Now, gross margin for Greg Crabtree is a little bit different than gross margin that we talk about, because he considers gross margin to be your gross profit, so revenue minus overhead expenses, but inclusive of field labor into that. What we consider gross margin, he considers contribution margin. So that would be the actual gross profit that we calculate. So it's a little bit different there, but still that ratio just tells you how much dollars in labor you're spending and how much it's producing for your gross profit margin. So 2.0 is your goal. And you can also, in the spreadsheet, change your numbers in terms of your revenue forecast to see how that negatively or positively impacts that labor efficiency ratio. The 2.0 is based on the companies that he's serviced. 90% of them, if they're at a 2.0 or higher, they're efficient with their labor and they're likely going to make a profit. What this is also going to tell you, if you're well above 2.0, maybe it's time to add labor into your field force because you are ready for growth. You've prepared yourself for growth with your profitability. Or it's just suggesting that you are optimally priced. So you're priced effectively and you're making effective use of your labor as it currently stands. However, a low direct labor efficiency ratio tells you that you have inefficiencies. That could be due to your workers in the field, could be due to systems and processes, management. Or another thing to consider is that if you do measure this on a monthly basis, this could be seasonal. So think spring, when we're kicking off, lots of mud, lots of a little bit more difficult. You're going to be less efficient, as well as you're likely training new hires in the field for that first time. You're going to be less efficient. But if that kicks up after that spring into summer, you're likely going to be a little bit higher with your dLER ratio. And then once again, coming back to the winter, likely less efficient. But at least at the budgeting level, you have something to go off of to know whether you are efficient or not at that sales that you want to do at that level. What the mLER, or management labor efficiency ratio, suggests is your effective costs of management, of overhead labor. Is it efficient? So we're looking for a 3.0 or higher. And what that helps you see is if you're low on management labor efficiency ratio, perhaps you need to increase your efficiency in the field, once again, coming back to that dLER ratio, or increase sales. Or even better, if you are high, you can now see ways in which you can take tasks off your plate as the owner operator by making a hire to get down to and not below that 3.0 layer. What this helps you do is it's almost like a salary cap. And Greg Crabtree talks about this in his book, where as a business, we have a salary cap that we can spend. And this mLER ratio helps you to note whether or not you can afford to hire an admin person, or maybe you can only hire a part-time admin person based on this ratio. So if I'm at a 4.0 or 5.0, I can go into my overhead, add in a full-time admin person, what I would pay them as a salary per year, and then I can come back to that ratio and see, am I still above that 3.0 mark? And how's my net profit doing as well based on my budget? And if I'm still looking good, maybe it's time to hire that admin or whatever overhead labor position you would need in your business at that time. And this is how these ratios help, what they help you with in your business. They help you to see and set a salary cap of what you have available to make a hire, whether in field or as a management or overhead labor, to then see if your business is ready for that hire. Now, this does come down to creating a solid budget in your business to note this, because you can quite easily say that, you know what, we did $1 million last year, and you know what, we want to 10x that. We want to go to 10 million. Well, how are you actually going to do that? Is that reasonable? Is that something that you're going to actually 10x the amount of labor force that you have in the field? And how are you going to do that and keep up the standards in your business and actually manage them appropriately? Who are you going to also hire in terms of management? So you do want to forecast with some logic involved in this. If your goal is to increase revenue, how are you going to go about that? Because that also comes with other general expenses in our overhead. You're going to have to pay for marketing to be able to get more leads into the business, to close more leads. And first and foremost, are you priced where you should be for what work you do and for your market as well, which we'll talk about now with also the 3 different overhead recovery systems. We want to take a break from today's episode to thank our sponsor, Cycle CPA. It's crucial to review your financial statements on a monthly basis so you can diagnose areas for improving your business's financial health early before they become significant issues. Too many contractors wait until the end of the year to review their financials as they file taxes, when it's often too late to take action to change the outcome. Cycle CPA not only handles bookkeeping and taxes, but they also ensure that you're armed with financial data on a monthly basis to make key business decisions. They offer benchmarking, cash flow forecasting, and assistance in developing targets for financial metrics. With their team of accountants specialized in the hardscape and landscape industry, they currently work with hundreds of companies in this field. Visit cyclecpa.com, and for $200 off, mention the How to Hardscape podcast. Now back to our episode. So we've got multiple overhead recovery, single overhead recovery, and a labor rate. And personally, I like the labor rate recovery method. For this, we really just want to focus on our overhead, and we don't have to budget a sales goal or anything like that. Our overhead is the main thing that we're going to budget for our labor rate, because it puts all of the overhead recovery specifically on labor. And I like this because we sell labor as service-based businesses. If we go to our cost of goods sold, we have labor, equipment, materials, and subcontractors. The most consistent thing on every project is going to be labor. Maybe you get a job and you're not going to be using any equipment. Maybe you get a job, you're not going to be using any materials. You're just supplying your labor, and maybe you're not going to use subcontractors. It's just the most consistent thing that's on every single project that we quote. Whereas we would never have a project where we only supply equipment, because then we'd be a equipment rental business. Maybe you do rent out your equipment, but do that based on a hourly rate, a rate per day, whatever you want to do for that, and see what a rental company is actually going for this. We're never going to only sell materials. If we did, we'd be a material supplier, and we'd never only be a subbing out jobs, because then we'd be a general contractor. Our labor is the most consistent thing throughout, and that's why I like the labor rate recovery method. Now with this, you want to make sure that you're hitting your hours. One, that you have budgeted hours correctly. I always carry forward last year's hours that I worked and carry that forward into this year. And then from project to project, the main thing that I want to know is that, am I under hours, hitting hours? And I don't want to be above hours, especially from project to project, because that's where this is going to fall apart. I want to make sure I'm hitting those hours. I still do charge retail for my materials, so I do have a slight markup on my materials anyways, and I justify that by just noting that we have a good relationship with our vendors, so we do get a percentage discount. My customer, my client, could never go and get our contractor pricing. So if they did want to do the project themselves, they would be getting retail anyways. So I do have a slight variation for that labor rate recovery, where 100% of my overheads recovered through that labor, but also I'm still getting a material markup by charging retail. And with this, you can recover by employees or you can recover by crews. So all this does is if you set your hours for the year, you have 1,600 hours a year in the field, and you're quoting a project that is 160 hours, that's 10% of our hours, 10% of our year. And so we will add 10% of our overhead to that project. So our total overhead that gets added to the project, as well as our labor costs, our materials, our equipment, if we have equipment in cost of goods sold, and any subcontractor costs as well. And we'll get a breakdown of our overhead recovery rate per employee, or if we're pricing by crew, our overhead recovery rate per crew. I always say if you are consistent with your crews in terms of the number of employees on it, recover by crew. If you have inconsistent employees on each crew, then recover by employees. All this does is it breaks it down by, if you choose a number of employees to recover by, if you have 5 employees, each employee will get a percentage of overhead applied to them. If you recover by crews, the percentages would just go to those different crews broken up evenly. So 2 crews, each crew would get 50% of overhead. 5 employees, each employee would get 20% of overhead applied to them. So if you have 5 employees, 2 crews, you might have 3 employees on one crew, 2 employees on another crew. Best to recover by employee. And then you also get your average hourly rate per employee, as well as a breakdown of the rate per hour and rate per day per employee based on what your budget is. Same thing with equipment. You get your cost per hour, rate per day for that piece of equipment. And with equipment for labor rate, you are going to have a very slight markup on your rate per hour versus what it costs you, just because we're only accounting for net profit. Once again, our overhead is not recovered through equipment using the labor rate recovery method. Now, single overhead recovery just gives a same percentage markup on all of your cost of goods sold to recover your overhead. So this is your labor, your equipment, your materials, your subcontractors. They all get the same percentage markup to recover your overhead. Not my favorite, and we'll get to multiple overhead recovery as to why, but then you'll get the same breakdown that you got in terms of your employees, their average hourly rate per employee, the individual employees, what their rate per hour is, what the rate per day is, as well as your equipment rate per hour, rate per day. We won't spend too much time on that. We'll go right to multiple overhead recovery. And what this does is it gives different percentage markups on your cost of goods sold. So labor comes with the highest percentage markup to recover overhead. And that's, once again, coming back to that labor rate recovery method. Labor's on every single job. It's the most consistent thing, but it also requires the most amount of overhead to manage and to make sure that they are efficient. So that's why it gets the highest percentage. You adjust the equipment, materials, and subcontractors markup as to what you want, and then any remaining overhead goes right to labor. So you can edit the percentage markup on equipment, materials, and subcontractors as you see fit, and then any remaining percentage goes to labor to recover that overhead. These percentages don't add up to 100. They're not meant to. They're meant to recover your overhead. So if you put a 25% markup on equipment, 15% markup on materials, 5% markup on subcontractors, whatever remaining overhead you have and what your labor cost is, the system here will calculate what your overhead markup, your labor markup should be to recover that remaining overhead. And the thing I like about multiple overhead recovery system is that it diversifies where your overhead recovery is coming from. So if you're off a little bit on labor, well, maybe equipment overhead markup will kind of even things out, or materials and so on there. But ultimately, you still want to measure this from job to job. It does bring in a little bit more complex job costing in terms of making sure you're hitting each of those numbers, as well as you do have to, and same with single overhead recovery, you do have to accurately budget what your labor, equipment, materials, subcontractors are. Whereas labor rate, you don't have to set a sales goal or anything like that to get to it. It's helpful, but it's not necessary. Labor rate only mostly requires hours and making sure that we're hitting our hours. Another reason why I don't like multiple overhead recovery system would be that you really want that percentage of revenue for all your COGS, so materials, equipment, labor, and subcontractors, to be the same on every project as it is in your budget. So the budget percentage of revenue for each of those should match more or less every estimate that's going out the door, so that you're hitting your overhead recovery markups and your overhead recovery on those. And that gets really difficult, especially in a business like mine, where we might do design build and we might do lift and relay. which both come with very different percentages of revenue for each of those cost of goods sold category. And that can really throw off my overhead recovery if I don't know exactly how much I'm going to do of either of those throughout the year. The easiest example would be the subcontractors. If that is let's say 5% of your revenue is subcontractor work, and then you're pricing a project and you don't have any subcontractors on the job, well, you miss out on the overhead markup that would be associated to subcontractors on that. Even something different would be maybe it's a heavy labor project, small materials, small amount of equipment for this. Well, it's going to actually overestimate your overhead recovery because labor comes with the highest percentage markup, which means you're likely overpricing based on what you need to be at. Or even worse, maybe it's a heavy material project and low labor, and it just doesn't match what your percentage of revenue is for those. That's going to throw off your overhead recovery. So what we've developed in our headquarters software, and we can't do this with this budgeting spreadsheet because it's just a budgeting spreadsheet, but with our estimates in our software, we're able to give you alternate percentage markups on your multiple overhead recovery to match whatever percentage of revenue each of those cogs are from your estimate compared to what your budget is as a percentage of revenue, and use that information to suggest an alternate markup to hit what your overhead recovery should be. So that's an interesting part that we've developed for this and for our How to Hardscape headquarters software. I haven't seen anyone do this, and it does solve what I don't like about multiple overhead recovery for the most part, and I'm calling it a dynamic multiple overhead recovery system. One thing that our spreadsheet does do is it allows you to see these 3 different overhead recovery systems and decide which one works best for your business, because they're all going to produce different rates for your employees and different rates for your equipment. And that allows you to make an informed decision for your business. It's just important to pick one and stick to it as opposed to varying that from job to job. Once again, with multiple overhead recovery, we see our average hourly rate per employee, what each employee's rate per day is and hour, as well as our equipment rate per hour, rate per day. Now, we get asked this a bit, and we want to take a break from today's episode to thank our sponsor, Knowledge Tree Consulting. They are efficiency consultants in the industry with 35 plus years of industry experience building Oriole landscaping in Toronto, which they are completely hands off at this point. George and Peter have been on the podcast before, and George on multiple occasions now. I've personally leaned on him to help with the How to Hardscape headquarters software and how we can maximize the efficiency of user experience. And I know the guys at DTE Landscaping, Chuck and Jeffrey, who we've also had on the show multiple times, have hired them on in the past. Check out their consulting services, peer groups, and events that are coming up on their website, knowledgetreeconsulting.com, or check them out on Instagram at joinktc. Now back to our episode. The question of my average hourly rate per employee is too much for my market, and what can I do to change that? There's quite a few things that you can do. One is you can reduce your forecasted sales, and this is going to negatively impact your profit, but it's going to lower your rate per hour, rate per day per employee. So perhaps you have an overinflated amount that you think you're going to do for sales or revenue for your business. Then it might be time to reevaluate that. But once again, going to negatively impact your profit percentage. So think about that. Another thing you can do is you can add field labor hours, and this can be done by reevaluating how much time you have in your season and adjust those. Add more hours if you think that's doable. You can also add more field labor employees. So especially when they come at a lower cost per average, based on what you're already have hired in the field. Especially if you're an owner operator, this is the best way to go about that. If you're the only person working in your business, your rate per hour is going to be very high. But as soon as you add somebody that's $20 an hour, that's going to bring down your average hourly wage, which will then bring down your rate per hour, rate per day. And as you add more employees like that, you do get to a threshold of being inefficient in the field. So 3 employees is kind of a sweet spot if you play around with your numbers in the system, because once you add that 4th employee, you get a decreasing return on efficiency in the field. That 2nd employee that you add in the field is going to be a good boost in efficiency. That 3rd employee is going to have a decreasing return on efficiency. And then that 4th employee, even more so, a decrease in efficiency, depending on the work that you do as well, though. But evaluate that in your business. Third thing you can do is increase efficiency. And this can be done by increasing your total production hours or reducing your unbillable time. So once again, increasing your production hours or taking away unbillable time that you've budgeted for. And can you do that? Is that possible? 4th thing that you can do is you can audit your general expenses in your overhead. What can be eliminated, decreased? What equipment can you sell? And so on there. Number 5 is you can audit your overhead equipment. Once again, what can be sold? What can be, or what have you put in there that you can increase the years of use that you have on it, because it just does not get used a whole lot. And then finally, and what I focus on, is improving sales process or value to your clients, and clearly communicate that based on your market. If you're closing projects with a higher than market rate, that is good for your profitability. So if you can find your closing rate is, if you do find that your closing rate is low, then you may have to decrease your profitability to be within the market pricing or improve your sales process. The budget is there for you to play around with and to see where you would be and maybe compare that to your market, but ultimately you want to be higher than your market for profitability purposes. So what I focus in my business on doing is work on that sales process. I'm not a great salesperson, but I've got a great sales process. And that starts with my YouTube channel and being very transparent and showing exactly what we do. And we have videos on every step of the process. We send a welcome package to our potential clients right away, say, hey, see our portfolio in this, but it also gets them to see my face, to click on the YouTube videos that are linked throughout that welcome package, and to see how we install things. So they already know and are getting to know, like, and trust me by clicking around on that welcome package. But in addition to that, when we send our proposal, we're breaking everything down step by step as to how we do it, and we're linking those YouTube videos in there so that they can compare apples to apples and not apples to oranges when they're comparing, especially in a more competitive market, which has really helped my sales process and has really helped me to price myself higher than what my market is. But once again, this spreadsheet is available for you on the howtohardscape.com website, as well as our workshops. This is available also in our headquarters software. So that is going to, for anybody listening to this that is a part of the software, this is going to be next month's features that we roll out. Basically, our current system for budgeting is specifically labor rate recovery overhead method, and we're just adding more and more features and more breakdown of your numbers to be able to revisit it as you would with the spreadsheet to see what you can do in terms of increasing efficiency, whatever it is, to hit the sales goal that you want in your business. And if you are a headquarters software member, you do get free access to the spreadsheet, to our workshops. So just send me a message if you're interested in that. And but also, if you are a software member, you can also book one-on-one calls with me at any point in time, and we could do this one-on-one if you ever wanted to as well. But I hope this has helped you in some way. If it has, please share this with somebody that you think would find this helpful. And I do really appreciate you listening to the How to Hardscape podcast into this. And before we say goodbye, we want to say thank you to our sponsors. Cycle CPA. If you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And Knowledge Tree Consulting. George and Peter there are efficiency consultants in our industry, and I've had the privilege of having them both on one episode of the How to Hardscape podcast, and George multiple other times. Always great episodes, and I also got to sit down on a one-on-one with George and went through what they do for businesses, and I left that meeting with a lot of value, so I can't recommend them enough. If you want to learn more about what they do, go to knowledgetreeconsulting.com and get that conversation started with them today. And we look forward to meeting you next week on the How to Hardscape podcast.